Good morning. We are going to work on Chapter 2 today. We've got a lot to cover today, and again, unless you've had accounting in high school, it's going to feel very foreign, going to seem kind of odd because it isn't a natural language per se. This takes practice. A lot of it is write it down and keep it beside you as a reference. So we're going to get started. First thing we're going to do is we're going to do a question in learning catalytics. So we're going to switch over to that now. The session ID is on the screen, and you can just sign into learningcatalytics.com. The session ID is, Haley will type it in the chat window too, 60736971. So there's a question there to answer. And we had a question earlier in the chat window if Learning Catalytics was for credit today. Learning Catalytics is for credit every single day we use it. You have to answer a question to get credit for it. I do not have it turned on to measure accuracy. So if you answer the question, you get credit. And you have to, if we have 10 questions during a given day and you answer 8 of them, your score for that day is 80%. If you answer all 10, it's 100%. So just make sure to get your answers in. This one will take a minute or two. Make sure everyone's logged in. And this question relates back to last week, sort of, and we talked a little bit about it Monday as well. I'm looking for that number there. Hello. I knew I'd say hello. Pardon me? Yeah. Yeah. BAP is at 5:15 today. What room? 115. 115, wherever that room is. Yeah. Did someone raise their hand? Yeah. Mm-hmm. Yeah. I mean, yeah, and. Okay, tell you what. We're gonna leave this question open for a little bit. I'm gonna start talking and let people answer for the next 5 minutes or so. So you're gonna have to keep posting the session ID keep scrolling as it scrolls. As people enter, keep entering. Just keep pasting it. Session ID is, because you know people enter, they don't see any chat from before. Okay, what we're going to do right now is we're going to get started. I'm going to leave this question open for a few minutes in the background. So Haley is going to keep putting the session ID in the chat window. For those of you that don't know, if someone joins us late, you don't see the chat for anything before the minute you join. So she'll keep typing that in the chat window. So we'll switch back to, so the question is still going on. So if you're getting logged into Learning Catalytics, you do still have a few minutes to do that, even though we're not showing it on this screen in just a minute. Okay, so that Learning Catalytics question is still lurking there in the background. We'll switch to it in a couple of minutes. And the session ID, if you need it, Haley will be repeating it in the chat window. Okay, so that said, just a reminder what's due this week, all sections, Chapter 2 homework. Chapter 2 homework is going to take some time. This is one of those fundamental chapters for everything we do. So you do need to allow adequate time for it. There are some short videos that are part of the homework. You get credit for viewing the video, so you need to watch those as well. If you're in Section 3 watching this later, you have a quiz. It's only Section 3. So Friday, this is 1 week. Well, I would say this every week, but this week I would really urge you to consider attending on Friday. This chapter is so fundamental. If you don't get this chapter, it's going to be a struggle the rest of the semester. And this Friday we're going to be doing a lot more practicing about what we're doing today. Today we're doing debits and credits. And debits and credits are a wonderful system, but at first it doesn't make a lot of sense. So we're going to do more practice on Friday. So we do have that optional session on Friday, and it's on Blackboard. There's a link to it, and I'll send a reminder out Thursday night as well, so you can link to it. And we're going from 8 to 9, generally 8 to 8:45 or so. Okay, so let's see. We'll leave that question open for a little while. As soon as we get done with this, we're going to close that question. So anyone coming in late can look at the chat room for the session ID and grab that question. Okay, we're going to start with an exercise, which is kind of a review from Monday. This is short exercise 2-2, and we have a company, it says it began with cash of $15,000, bought supplies for $4,400 on account, and paid $7,500 for equipment. And we have to answer 2 questions. We have to answer how much in total assets do they have, and how much in liabilities do they have. So to answer this question, it's not too bad, but you kind of have to sift through what they've given you. The first thing, their asset. When we have to go through here, they're asking for total assets, they're asking for liabilities. So you have to go through here and say, okay, what's an asset, what's a liability? The first thing given is they began the year with $15,000 cash. So that is an asset. That's the beginning balance of cash. Then we bought supplies on account. Now supplies are an asset. Supplies are something that we buy now for future use in the business. And so when we talk about bought supplies for $4,400, actually that has 2 sides. It's a transaction. As opposed to this first sentence. The first sentence, cash, that's a beginning balance. That doesn't have 2 sides. That's not a transaction. That's simply saying we're starting with $15,000 cash. This next one, bought supplies for $4,400 on account, that has 2 sides. We bought supplies. Supplies are an asset. They're something we're going to use, have future benefit to us. So we have an asset that increased. And when we buy it on account means either accounts receivable or accounts payable. Accounts receivable deals with our customers. Accounts payable is stuff we're buying. So this has to be accounts payable. If we buy it on account, our liability is increasing. So in this bought supplies for $4,400 on account, what happened there is assets increased, liabilities increased as well. And then finally, this last sentence, we paid $7,500 for equipment. So again, that's a transaction. We paid $7,500. $7,500 is cash. So cash went down, and computer, which is an asset, went up. So we had 2 sides to the there are 2 transactions listed in this exercise. First of all, we bought supplies on account. Secondly, we paid $7,500 for equipment. So those are our 2 transactions. Every transaction has 2 sides. Okay? And then we have a beginning balance. So now we can go to answer the question. So you have those numbers that we just had, the $15,000, then the supplies, asset supplies going up, liabilities going up, assets going down, and assets going up. All those become important. So what we're going to do now is this question of how much in total assets do they have. Well, we would look back here and we pick out every asset that we had. So here what we see is we see cash of $15,000 is our starting balance. Then we had asset supplies go up by $4,400. And then we had cash go down for $7,500. And we had assets go back up for the computer. So we can have an assets go up and down in the same transaction. If we buy a computer, for cash. So let's go to this question. How much in total assets do they have? What you're doing then is you're taking the $15,000 beginning balance, you're adding to it the, so let's go back, the $4,400 here. We bought supplies, $4,400, that asset increasing there. Okay, the $4,400 is the supplies we bought on account, the asset increased. The $7,500 is the computer we bought. The $7,500 subtracting is the cash we paid for the computer. So those are both an impact on assets. So the answer to A here is $19,400. I would tell you that this is one of the most popular questions I'll get on the homework this week. When you do this homework, invariably people will email me and say, why do you have to subtract $7,500? And the reason is because you reduced an asset. You got an asset, you got equipment, but you spent cash to get it. So the impact there is you have one increase, one decrease. So you do have to decrease it. So when you do your homework, when you do short exercise 2.2, it's going to look just like this, just different numbers. So you have to remember that that one has two sides. And then how much in liabilities does this company owe? What we're going to see there is $4,400. There was one liability in that whole discussion we had of analyzing. They bought supplies for $4,400 on account. That was it. Okay, let's switch back to learning catalytics. Okay, learning catalytics. I think this is the first question. Hopefully you've answered. You've had a chance. We're going to close it in about 5-10 seconds. I'm looking over your shoulder here. Okay, we have a couple people who've not answered, so make sure you answered. We're closing in about 3 seconds. Yeah, and then you're going to load one more. Okay, goods purchased on account for future use in the business, such as store supplies, are called what? Those are prepaid expenses. And let's talk about the other things, so why we know it wasn't any other answer. First of all, we purchase goods for future use in the business. That sounds like a future economic benefit. Accrued liabilities are debts that we owe others. That has nothing to do with these supplies we have sitting here in front of us. So it's not accrued liabilities. It's not an expense because we haven't incurred it yet. It's future use in the business. Revenues it's not revenue to us. So a prepaid expense is an asset for future use in the business. So prepaid expense is one of the few accounts that isn't what it sounds like. Because it has the word expense in it, it's not an expense. Prepaid expense is an asset. Okay, so let's go on. Let's do one more. Yeah.
So even though it says it's not a liability,
the question is because it said on account it's not a liability. Remember, every transaction has two sides, and in this case it was asking us about the supplies. It wasn't asking us about the liability. It was asking us about the supplies. How is that categorized? Okay? Okay, a company paid cash for an amount owed to a creditor. This transaction decreased cash, and what else did it do? So we paid something we owed to a creditor. Okay, we've got about 5 seconds. We have 20 so people not clicked in yet, so you've got about 5 seconds to enter your answer. Five seconds, Haley. Again, you get credit for answering. So answer. The answer for this one is decreased liabilities. Now, when we pay cash for an amount owed to a creditor, an amount owed to a creditor, typically accounts payable, it's a payable, it's a liability. So when we're paying cash, we're reducing our cash, but we're also reducing our liability. We don't owe them as much anymore, so the liability goes down. So the answer here is decreased liabilities. Okay, so let's go back into another homework. Okay, now we're going to do another homework exercise, and we're going to look at several transactions and talk through the impact of those transactions. And when I look through this problem, typically when you tackle a homework problem or a question in general, I like to look at what's being asked here. It says, after these transactions, how much cash does the business have to work with? Okay, so we are looking at for how much cash the business has. And it says use a T account to show your answer. That's kind of secondary, and we'll talk about that coming up. But we're looking at how much cash the business has to work with. So we're going to analyze these transactions. And when we analyze these transactions, it's not asking me for the overall what happened. It's not saying, tell me the journal entry for each transaction or anything like that. It's not asking me for both sides. It's asking me, my end goal here is to find out how much cash the business has. That's all. Okay? So I'm going to look at every transaction given to me and ask, first of all, does it have an impact on cash? And if it does it increase or decrease cash? That's all we're doing here. So the first transaction, July 1st, she invested $60,000 to start her medical practice in the business issued stock. So the question is cash impacted? And yes, it is impacted, right? So does cash increase or decrease with this? Think about, we're doing it from the standpoint of the business. She invested $60,000 cash in the business. So what's happening to the business is cash. Yes, yes. We are always doing this from the standpoint of the business. Okay? So the business receives $60,000 cash, so this is going to increase the cash by $60,000. So we have $60,000 increase to cash. So now we'll go on to the next one down. And again, we're not being asked for the transaction, both sides of it. We're only looking for the impact on cash of these items. So then the second, okay, let me see. Let me see what that other one, I'm having trouble reading that one that I missed. Okay, July 1st, the one right below here, not the one circled. I see why I don't have it circled. But July 1st, it said purchased medical supplies on account totaling $12,000. Does that impact cash? No, that's why I didn't have a slide for. I guess I skipped the slide for it. So purchased medical supplies on account has absolutely zero impact on cash right now. We could make the argument that later on we have to pay for it, and that's fine, and we'll look at the impact later on. But right now, this transaction, we received supplies, we have now a liability that we didn't have before, but there's zero impact on cash. So we don't need to do anything with the second July 1st transaction. So now we go on to July 2nd. Paid monthly office rent of $4,700. So we ask ourselves, is cash involved here? And this is where we have to watch the subtlety of the language. When you see the word paid, unless it said otherwise, that implies that we're using cash. Okay, because how do we pay rent? We're going to pay with cash. So this certainly impacts cash. Okay, we paid monthly office rent, so did it increase or decrease cash? Decrease cash, excellent, yes, yes. So this one would decrease cash, I just put a minus sign in front. So we decreased cash by $4,700 when we paid the office rent. And then we have one more transaction here, July 3rd. July 3rd, we recorded $10,300 revenue for service rendered to patients, received cash of $4,200, and sent bills to patients for the remainder. So that difference got billed out. So what we've got here is we have, it tells us, we look for the word cash, that's usually a good thing to start looking for. We received cash of $4,200. So that cash of $4,200 is going to increase cash by $4,200. Okay, we received cash. Now, we can go back to answering the question, after these transactions, how much cash does the business have to work with? So what we've done is we've pulled out the impact on cash. We had $60,000 increase, $4,700 decrease, and then a $4,200 increase. We didn't have any beginning balance because it said she just started her medical practice, so we have no beginning balance. If we're not told beginning balances, it's usually pretty good to assume that they're just starting. So now we need to know how much cash we have left. Okay, so we can visually say I'm going to take plus $60,000 minus $4,700 plus $4,200 and get my ending cash. But it says use a T account to show your answer. So a T account, what it is, we're going to see a little bit more of this a little bit later. A T account is just a way to represent what's going on in an account. Okay, so in cash, in accounts payable, and accounts receivable. And we'll have a T account, and it just is a way to keep running total. So for cash, what a T account is going to look like is this. So a T account starts by looking like a T. Ignore the second line. But it's going to look like a T. So we'll have a horizontal line with a line down the middle. And across the top of the horizontal line, we write the name of the account. So we wrote cash. Now we'll talk in a little bit about what the different sides mean, but my T account here is only for cash. It will work for any asset. It's an asset T account. But what we're going to do for an asset in a T account, the increases go on the left side. So our $60,000 increase in stock goes on the left side. Our $4,200 increase in cash goes on the left side. Or the $60,000, by the way, $60,000 from stock goes on the left side. The $4,200 increase to cash goes on the left side. And then decreases go on the right side. And again, we're dealing with a T account for cash. So it would be different depending on the type of account. So once we have the $60,000 and the $4,200, and then we have the $4,700 on the other side, we draw a line under it. And what that says is we're going to write the balance now. We're going to figure out the balance. And the balance is how much cash do we have to work with. And what we do is we add up the numbers on the left side and subtract the numbers on the right. So we'll take the $60,000 plus $4,200 minus $4,700, and we get $59,500. We write the $59,500 on whichever side is larger. So we know that 60,000 plus 4,200 is larger than 4,700. So the balance gets written on the side that's larger. But we get the balance by adding everything on the left side, subtracting everything on the right side. That's our balance. It goes on the larger side. This is simply a way to keep track of what's going on in your accounts. We're going to have a lot more going on with T accounts coming up, and we'll talk about the difference between a T account for an asset and a liability. They're a little bit different, but the same. For an asset, the increases go on the left and the decreases go on the right. Okay, so that's just a real basic introduction to a T account, and that's what they're asking for here. And that second line, horizontal line, just says the total's coming up below here. Okay, so the answer to the question, how much cash does the business have to work with, is $59,500. You have to represent it in your homework like it's shown on this in a T account, and that's all there is to that. Okay, questions about that? We're going to do more T accounts today. We'll probably do some T accounts on Friday as well, and T accounts are going to be with us the whole rest of the semester as well. Now what we're going to do is, so we've got some basic building blocks. Now we're going to go into analyzing transactions in a bigger scale using debits and credits. Okay, so we've already said every transaction has two sides, and that's called, in accounting, that's called a double entry system. And a double entry system says that whenever we have a transaction, we have two sides to it. And the impact on the accounting equation will always keep the accounting equation in balance. And we have T accounts. So going back to our T account, now we'll talk a little bit more about it. When we talk about the left-hand side of a T account, it is called the debit side. Okay? So that will not change regardless of what kind of account it is. It never will change. Debits are on the left, credits are on the right. On your sheet for the exam, we're going to have lots of things today that I would put on it. That's the first of them. On a T account, debits on the left, credits on the right. Okay, so a T account is a representation of what's going on in any account we have. Any asset, any liability, any revenue, any expense. It's a representation, and our debits go on the left, the credits go on the right, and we'll see those. We're going to use them coming up. But a T account represents, it's a way for us to represent accounts. Okay, so again, debits on the left, credits on the right. That's your most fundamental T account. Now, we're going to be using debits and credits now. So we started here. When we get to T accounts, the debits go on the left, credits go on the right. So now we say, how do we know what's a debit and credit? And that's what we're going to spend a fair amount of time on. You want to make note of this for later. I'm not handing it out in class, but this can be very useful. We will use this on Friday. This is a handout I made. It's at http://tiny.cc/debit-credit. And this is just a one-page PDF document, and it gives you, lists the steps that when you go to figure out a journal entry, which we're going to do a lot today, the actual steps that you could go through to figure out that journal entry. So step one, you pick one account that's affected by this transaction, and then the account that you picked, is it increasing or decreasing, what type, and then combine your answer to pick in step 4. So just keep that in your back pocket, because after we finish up all of this, that may become useful to you. I'll send it out in an email about it, but it's a useful reference as we go. But we're going to go step by step. So our debit credit rules. Debit credit rules, again, this is something absolutely positively I would have on my exam sheet. I would have it on a reference sheet when I'm doing my homework. I would bring it to class and have it as a reference, because when we do questions in here, these rules right here will get you through so many questions. You just need to have that. You will be able, if you're an accounting major, you're absolutely going to have this memorized down flat by the time you're out of school. Right now, you're not. Do not waste brain cells trying to memorize all this, because you can have it right beside you and use it as those training wheels when you're first getting going. So debit and credit rules. Debits will increase certain types of accounts. Debits will increase assets, expenses, and dividends. Okay? Debits will decrease liabilities, common stock, retained earnings, and revenues. And then the opposite holds true. So I'm going to pause for a minute so you can write those down. But those are based on this accounting equation, and everything's always in balance. Again, this slide is one of the most important things you could have written down. Keep it for the entire semester. You're going to need it throughout the whole semester. And I'm not assuming you memorize this. I'm assuming you've got it handy, but we need this knowledge to go forward. So this is going to be one of those things. This is one of the reasons you have a sheet to bring with you to the exam, because I don't want you memorizing all this, because if you memorize all of this, it's really easy to get confused and get things backwards. So you have it to refer to. So we're going to do a couple journal entries now, and I'm going to put up a couple questions, not learning catalytics, but a couple questions, then we'll go back to learning catalytics and try some. But I just want to jump in and use this information. So I'm going to go out of order here. I'm going to do this one. Okay, so let's say we're going to do a journal entry. And we have a company buys a new machine for $8,000 cash. What's a journal entry? A journal entry is a way of recording a transaction. A journal entry is telling us what account, what are the two accounts in a given transaction and how are they impacted. So when we do a journal entry, in the old days, we would have had columnar paper. Many 50 years ago, they had columnar paper, and they would write journal entries on the columnar paper. And that kind of schema still continues today, even though it's electronic. So we have the same thing. So in a typical journal entry, you have a date. You have to have a date on the journal entry. When did it happen? And then you have a space for account, the account name, and then an explanation. You'll see where we go with that. And then you'll have a debit column and a credit column. Debit column is always first. Credit column is always second. Well, now, we bought a new machine for $8,000 cash. So before I worry about what I'm recording, I'm going to talk about what's going on here. When I look at this, what's one thing involved here? When I look at this, we buy a new machine. So there's equipment, okay? So there's equipment. That's one account. What's happening to that account? It's going up because I bought equipment. And then and then the other side of this, we bought it for cash. So you're looking for the two things. There's always at least two accounts involved there. We have equipment and we have cash. So let's deal with equipment first. If I look at my list of debit credit rules, I have equipment. Equipment is an asset, and equipment is increasing. So I'm going to debit equipment for the $8,000, and then the other side of this transaction is cash. Cash is also an asset, so I'm going to decrease cash, so I'm going to credit cash. So I'm just going to show the journal entry. Now, the date is the date this happened. The equipment is the name of the asset. You always, always, always record debits first. So you have one account per line. So we have debits recorded first. That debit is in the far left. It's pushed up against the far left. It's left justified. And then the $8,000 goes in the debit column. Then my second row is my credit. My credit is indented. That is key. It's wrong if it's not indented. That cash is indented. It's not, because if it's indented, it implies it's a credit. And then the credit goes in the credit column. And then down below there, we typically have an explanation. We purchased a machine. And we do an explanation so that later on when we're looking at this, we know why we did this journal entry. And that's called a memorandum line or a memo line. So this is our first journal entry. So a couple things to point out too. We typically don't need to use dollar signs because we know in a journal entry this is dollars. Secondly, if I add my debits and then I add my credits, they will equal. In this one it's obvious that they equal because there's one of each. Later on we could have multiple debits and multiple credits, but for every single transaction the debits have to equal the credits. If you do this, if you said to yourself on this journal entry, wow, I don't know what to do, but I see cash. My preference on any journal entry is to say, what's happening with cash? And cash will be impacted by a lot of different transactions, this one included. And if you look at cash, you could say, well, we're spending cash, so cash is going down. Then you look at the sheet and you say, well, cash I know is an asset. To decrease an asset, I credit it. So I would skip to the second line, indent, write cash, and put $8,000 there. So then for the first line, I know I need a debit of $8,000, and right now you're 75% done, even if you don't know what the other side is. And then you can go through a list and make an educated guess. But these journal entries are not as hard as they look, plus they'll be very standard. If you have a journal entry for any other problem and it says bought an equipment for cash, it's going to look like this. You're going to debit equipment for $8,000, credit cash for $8,000, or whatever the dollar amount is. So these journal entries, once we figure them out, some of them you could put on your sheet and keep reusing them because they're not going to change. You don't necessarily have to analyze every transaction. There'll be some transactions that are very common. So this, like this one is, we bought something for cash. So you're going to debit something for the amount, you'll credit cash for the amount. That's 75% of it right there. So these journal entries are not hard, but you have to use that sheet of paper wisely to say, okay, these are the set of journal entries we've done. I can use those, but also being able to use those rules to figure them out. So we're going to do another one now. So in this one, we bought office supplies on account for $4,000. What's the journal entry? So now we have two accounts. We'll identify both accounts. We have office supplies. That's the first thing listed. Office supplies is an asset. And then on account. On account is either accounts receivable or accounts payable. Accounts receivable is our own customers. There's no customers involved here. We're buying something, so this is accounts payable. So we have We have office supplies, an asset, and we have accounts payable, a liability. So we buy office supplies. Office supplies are increasing. Assets increase with a debit. So what we've got here, office supplies increase with a debit for the $4,000, and accounts payable, we're increasing a liability. To increase a liability, we credit it. And then we have a memo line. Another one. We are going to switch over, do 2 questions, and then come back to a homework problem. Wait. Oh, just don't. Because once it's up, you can't. Yeah, because if we close it right now, only those people that answered would get credit for it. So once you put one up, we're going to go with it. Okay. So we have this question: which of the following statements about the rules of debits and credits is correct? Look at that sheet, the slide where I said this is so critical. And then we'll do that other one. How you doing with this? Right? Okay, another few seconds here. Make your choice. We have, Haley, 5 seconds. Ignore round 1. It doesn't impact anything. It's just a double click. Which of the following statements about the rules of debits and credits is correct? An asset is increased by a debit. We don't have to go any further. This is just to pick one. So an asset is increased by a debit that was listed on that sheet. You're going to get questions like this. On the exam, again, these are the type of questions where you go, yay, I got this one because I can answer it directly off the sheet. So let's do another one where we have to apply this. Okay, when a company borrows cash from the bank, what happens? So you're having to think about what's happening when we borrow cash from the bank. So think about the 2 sides and what kind of accounts those are. Okay, you've got about 5 seconds to enter an answer. So get your answer entered. So 5 seconds. Very good. When a company borrows cash from the bank, liabilities are increased. When we borrow cash from a bank, we have cash increasing, which is an asset, and we have liabilities increasing, which is, yeah, the liabilities, the answer here. We're going to do short exercise 2-6. We're going to go through a series of transactions. We have an architect that completed the following transactions, and we have to journalize the transactions. All that's saying is write a journal entry for it. Now, on these journal entries we do in class, I'm going to drop the headings. You'll see where the debits are and the credits are. We'll just show you. So the first one, October 15th, borrowed $64,000 from the bank, signing a note payable. Okay, so we borrowed $64,000 from the bank. So what's happening here? Getting cash, again, we're recording this from the business standpoint. So the business is getting $64,000 cash. Cash is an asset, so that's going to increase. And we're also, this is related to the question we just did, signed a note payable. Note payable is a liability, so that's increasing. So what we're going to see here is the journal entry I've listed on the screen below. The date, October 15th, cash is debited for $64,000. Note payable, a liability, is credited for $64,000. Things to note, you always indent the credits, and you also, credits go in the far right column, debits go in the second column over. So, and the debits have to equal the credits. The line below it, borrowed money from the bank, is a memo line telling you what this journal entry is for. You will need those on the homework. You'll have to pick a memo line, I believe. That's October 15th. So that's our transaction on the 15th. So we're going to move down and do the next October 22nd. Performed service for clients on account totaling $17,100. So we performed services on account. So we've got performed services. So performed services means we have service revenue. And service revenue is increasing. So when we look at our sheet for what we do to service revenue to increase it, revenues increase with credits. So we have our credit, but we can't write our credit first. It's our second line. The other part of this transaction, we have service revenue on account. On account automatically means accounts payable or accounts receivable. On account, when we're dealing with clients, means these are customers, so this has to be accounts receivable. Accounts receivable is an asset, so we're increasing accounts receivable. It's an asset. To increase it, we increase it with a debit. So what we have here is we're going to debit accounts receivable for $17,100. That's an asset we're increasing, and crediting service revenue for the $17,100. This journal entry here we'll see over and over. This is a common one you're going to see throughout. You'll see a transaction, perform service on account. That journal entry will always debit accounts receivable, always credit revenue, service revenue. That's always going to be. So perform service on account automatically gets this kind of journal entry. So again, you don't need to analyze every single transaction. You should have a list of these journal entries that are pretty standard at first. Next transaction down. Received on October 28th, received $10,300 cash on account from clients. So this is nice because cash is involved. So cash is coming in. We're going to be increasing cash, so we're going to debit cash. And then it says on account. On account automatically means accounts payable, accounts receivable. It said we're receiving it from clients, so that has to be accounts receivable. So what we're going to see here is we're going to debit cash because we're increasing it. Cash is an asset, and then we're going to credit accounts receivable for the $10,300. Accounts receivable is an asset. It's being decreased because the clients are paying off what they owe us. Okay. Next one down, October 29th, received a utility bill of $1,450, an amount that will be paid during November. So when we receive a utility bill, that means we've used utilities. So we have an expense here that we need to recognize. So expenses are increased with debit, so we're going to see utility expense debited, and then it says that we're not paying for this right now, we're going to pay for it later. So this is a debt that we owe, so that'll be accounts payable. So what we're going to see here is debit utilities expense, credit accounts payable. This is this expense that we owe, but we're not paying it right now. So we need to recognize that we have a liability. Okay, and then our final transaction is October 31st, paid monthly salaries of $10,100 to employees. So when we pay those monthly salaries, what we're going to see is we're going to debit salary expense, credit cash. We've got, when we pay something that implies cash is going out the door, cash will decrease with a credit. So we have a credit to cash of $10,100. Next, we're moving on to, we've talked about recording transactions. So we record transactions in a journal, which is a list of all the transactions, all the journal entries, all the transactions. So we record them in a journal, and what we do is we've done the journalizing part. But these transactions sitting in the journal don't do us any good. It doesn't tell us how much cash we have. We just have a long list of history. So somehow we have to get these transactions from the journal into the accounts, and that's called posting. So a journal is a chronological record of transactions. That's simply saying, here's all our transactions. We've recorded all the transactions. Here they are. Then we're going to be posting them, and that's the process of getting the amounts into the accounts. So here's a journal entry. So here's this process of posting. We visualize each account kind of as a T account. Again, many years ago they had cards, that one card for each asset, and you would record everything to do with that asset, and you can add it up and know what the balance is. Now it's electronic, but it's the same idea. So if we say, okay, we have two, in this particular case we have two accounts, but you have hundreds of accounts, but these are the two involved here. We have this journal entry which we would have written, we issued common stock, so this is just an example. A journal entry, April 1st, we debited cash, credited common stock. We issued stock for cash is what's happened. So we get cash, we issue common stock, so we have a debit to cash for $50,000, a credit to common stock for $50,000. To post those to the accounts, what we'll do is we'll take each number in the journal entry and post it to its related account. For example, cash right there. Cash is a debit. remember in a T account, any T account, the debits are on the left, credits are on the right. So in the cash account, I'm going to write the $50,000 on the left side. The common stock, the $50,000, goes on the right side because it's a credit. So now I've posted those two amounts to the account. I would do that with every single journal entry, and at the end I would have all these amounts in my accounts, and then I'd be able to total and get a balance for every single account. And that is the process of posting our accounts. Okay? So what we have in terms of information flow is the transaction occurs. Okay, so it happens. We analyze the transaction. Basically, we're saying what happened here, what increased, what decreased. And then we write the journal entry. And after the journal entry, the amounts are posted to the ledger. So, and the ledger is this collection of all our accounts. We have a general ledger. That's a collection of all the accounts. When we talk, and we represent accounts with T accounts when we're talking about them conceptually. But a ledger is a listing of all our accounts, and we're going to post those journal entries to the ledger. So we have an example here. So another architect, so whoever likes architects online, the architect purchased supplies on account for $5,000 and later paid $1,400 on account. Journalize the two transactions. So, and keep in mind, yeah, I just saw that in the chat window. All these slides are on Blackboard to download. So if you don't get everything written down, know that they are on there for later reference. And I see some people here that have them, and that's great. Then you can take your own notes in the margins. So the two journal entries here, first of all, we purchase supplies on account. If we purchase supplies on account, we're increasing assets, supplies, and we're increasing liabilities, accounts payable, and for the $5,000. And so our journal entry is going to debit supplies, credit accounts payable. The second transaction paid $1,400 on account. We're going to reduce that liability by debiting it and credit cash for $1,400. So those are the two journal entries, and you'll go back and think about those. But what I'm illustrating here is posting these journal entries to the account. So we've got the two journal entries. Now what we're going to do is we've moved the journal entries up, and now we have the three accounts that are affected by these journal entries. So first of all, supplies gets a debit for the $5,000. I'm just starting at the top here. So supplies, debit for $5,000. Remember, debits are on the left, credits are on the right. Accounts payable gets a $5,000 credit. Working our way down, the next one, accounts payable, gets a $1,400 debit. Oops, I went the wrong way. Okay, $1,400 debit. And then cash gets a credit for $1,400. So all you're doing is taking those journal entries and posting the amounts to the accounts that match the line on the journal entry and putting it in the debit or credit column depending on which one it is. So then when we have the question, how much does the business owe, it's looking for the balance of accounts payable. Accounts payable is the only liability listed there. So we can get a balance in that account. My line's off a little bit. That line's supposed to be below the $1,400. So we have $1,400 on the left side, $5,000 on the right. So the difference between the two is $3,600. We put it on the credit side, and that's the balance of what we owe for liabilities. As a note, I think coming up here, we have accounts have a normal balance. Accounts, different types of accounts have a normal debit balance or normal credit balance. How you know what an account's normal balance is what increases it. So going back to your sheet of what debits increase, assets, expenses, and dividends, those all have normal debit balance. Credits increase liabilities, equity, the revenues, etc. Those all have normal credit balances, and we'll see that coming up here. Okay, trial balance. So we get to the end of, and you can read about this. Again, you have these slides available to you. Accounting errors, we may talk more about that on Friday. Chart of accounts. These are all things you can read about. Normal balances of account, Exhibit 2-14, I said we would talk about, we would have more on it. Exhibit 2-14, this is important to know what a normal balance is. Rule of thumb, it's whatever increases an account. So assets have a normal debit balance, liabilities normal credit, etc. And again, that's Exhibit 2-14 in your book. We already did this. Okay. And I want to talk about a trial balance. So let's say, so during the period, we have transactions. We analyze them. We write the journal entries. We post the transactions to the accounts. And then at the end of the period, what we do is we make a trial balance. A trial balance is just a listing of all the balances of the accounts. The purpose of it is to make sure your debits equal your credits, that you did your arithmetic correctly, that you posted everything correctly in terms of debits and credits. So what we have here is we have a list of accounts, and these accounts are in no particular order, and you need to put them into a trial balance. And again, the only purpose of a trial balance is to make sure your debits equal your credits. So to prepare this trial balance, what we're going to do is we're going to go through these and list our accounts, and we'll have a list of accounts. We'll have a debit column and a credit column. The accounts go in the column for which that's their normal balance. And a trial balance starts with assets, goes liabilities, plus, and then equity at the below. Revenues come before expenses. It's always that order. The trial balance is always that order. And we always start with cash. Cash is always the first one listed. So they go in order of liquidity, meaning how close to cash things are. So let me do this. Okay, here's the trial balance. I'm just going to put it up there if you want to take quick notes, but what I want to show you. A trial balance is not a financial statement, but it starts looking like it. At the top we have the name of the company. The second one is what is this? And then the third line is the date line. A trial balance is a snapshot of one moment in time. So it's not as of or anything. It's December 31st. This is what these balances were as of the last day. We have then a list of all the accounts. Again, you start with assets, liabilities, revenues, equity, or revenues, expenses, and always cash is first. Accounts payable comes before any other liabilities. We have a debit column and a credit column. We put the account balance in its normal balance column. Notice too that this is millions. You do not add zeros to this. It will be wrong if you add zeros to it. It's implied that those 6 zeros are there. Okay, and again on the homework, if you ever forget that, you can click on the Help Me Solve This. It'll show you the general format. And if it's not showing 6 zeros on the homework, you would not put it on yours. Okay, so what you do is you list each of the balances. So cash has a normal debit balance, so it goes in the debit column. The next one down, other assets, normal. It's an asset, it has a normal debit balance. Accounts payable is a liability, so it has a normal credit balance. Other liabilities, credit balance. Stockholders' equity has a normal credit balance. Revenues, normal credit. Expenses, normal debit. So I've put my numbers in the columns, and what I'm going to do is draw a single underline under each column, and then I'll get a total. So I'll add my debit column up, and I'll get 52. I'll add my credit column up, and I'll get 52. I'll put a double underline under it and dollar signs in front of it if I were doing this in real life. And I'm set my trial balance right now. It's in balance. Your debits have to equal your credits. If they don't, you've done something wrong. So a trial balance, its sole purpose is to make sure that the debits equal the credits. It's not a financial statement, but it's a check we have to do before we go any further. So when you do this on the homework, the debits have to equal the credits, and if you do it in real life, it has to equal the credits. I've got a dollar sign listed in the first number in each column, dollar sign on the totals. That is not, you don't have to do that for the homework. That's just telling you convention how we do it. Now we're going to do some questions. I will also tell you that there's a couple homework problems that we'll be doing on Friday. So if you want to join us Friday, fine. If you don't, it's recorded. So if you need help with the other homework problems, most weeks we will not do all the homework problems during the week. We simply don't have enough time. So we're going to do some questions now. Okay, so first questions out there. Accounts are listed in random order in a trial balance. True or false? Okay, accounts listed in random order in the trial balance, true or false? 5 seconds and we're going to close this one. Okay, that one is false. Accounts are listed, assets, liabilities, equity, revenues, expenses. Cash is always first. They're listed in liquidity order. Want to put up another one? Okay, another true false. A trial balance is one of a company's major financial statements. True or false? I don't want to do that last one. You have another. Yeah, that's a good one. Okay. Okay, 5 seconds. Let's do deliver. No, I mean, can you display it? There. Okay. This is interesting. A trial balance is one of a company's major financial statements. That is absolutely what? It's false. Yeah. Okay. It's absolutely false. So a trial balance is not a financial statement per se. The major financial statements are balance sheet, income statement, statement of retained earnings, and statement of cash flows. Those are in the first four chapters. So let's go on to a new one. You should know those four statements and know that a trial balance is not one of them. And then we have one last question. So once you've answered it and confirmed you've answered it, we are done for today. The trial balance is used to do what? Okay, remember that Chapter 2 homework is due this weekend. We do have a supplemental session on Friday. We're going to go over some more homework problems and do some more debit credit practice if you want to join us. Have a nice weekend. But we're going to close the question in 5 seconds. And the answer is total debits equal total credits. That is the purpose for a trial balance.